This is the Retirement Key Podcast with Abe Abich, founder of Abich Financial Services.
And I'm Heather Branch here with Abe, asking for his ideas on things you can be working on as you get closer to your retirement goal line after decades of working and saving and putting away to your nest egg. At Abich Financial Services, they're spending their days helping folks just like you unpack that nest egg and figure out the different places you need to be making that nest egg work for you in your retirement. It can feel like a lot. It can feel very intimidating. The good news is you don't have to walk through this space by yourself. A local independent financial advisory firm with offices in Ashburn, Abe and his team have been helping folks all around Nova plan for retirement. I mean, are we close to 3 decades now, Mr. Abich? No, just 2.
So close to 2, yeah, about 17 years.
Yep. And we're getting calls all week and all weekend long from our radio program. Obviously, I don't have to explain to you how many people have questions and need help with this stuff.
Yeah. Well, you know the stats. 10,000 baby boomers are retiring daily for the next 7 to 10 years in a row. Mm-hmm. Yet, and we talk about this all the time, yet in our understanding, over 90% of the industry focuses on helping people to get to retirement. We call it phase 1.
Right.
They're lacking advice and guidance, support, education on phase 2, on that transition into retirement from the working career. Or if someone's already retired, they might still just have that big pile of money without a plan.
Yep.
And they're wanting to know when to take Social Security, how to handle RMDs, taxes, healthcare, Medicare, long-term care, estate planning, all of these things that really weren't important or relevant at all at 30, 40, and maybe 50.
Yeah. Well, they're relevant to you now. And at Abich Financial, they get it. They are helping folks, like I said, every day. They're here for you. In fact, you still have time to make an appointment before the end of the year. Start your new year off strong. And
that's right.
Let's begin the conversation. You can find us at theretirementkey.com. But speaking of timeframes, Abe, when you turn 73, as you likely know, if you're close to retirement, you know about Uncle Sam. That's when he says, okay, time's up on that non-taxed retirement accounts you've been sitting on, your 401k, your 403b, your TSP accounts. Uncle Sam requires that you start taking required minimum distributions, or RMDs as they're more commonly called, from those traditional retirement savings account. Many retirees do make appointments around this time of the year, Abe, with an advisor to deal with their RMDs in a lump sum manner. But is that the most strategic way for us to be managing our RMD, or should we be looking at it from a more annual, maybe a quarterly or even a monthly perspective? What's your opinion here?
That's a great question. I really think it depends on what the client really needs the most. If they really need consistent monthly cash flow, then taking those RMDs out over the course of a year could really help them. Maybe they don't need the cash flow. They have plenty of income and they want to kind of let the markets ride throughout the year and try to get as much return as possible before taking out that lump sum. I will say, here at Abich, most people probably do take out their RMDs as a lump sum towards the end of the year because a lot of our clients don't need that income throughout the year. However, whether you're taking it out monthly or quarterly or annually, that could come with a pro and a con, right? Like if you're taking it out monthly, well, that could help smooth out the distributions over the year, right? As compared to taking out a distribution maybe in November, what if the markets have fallen by 10, 20% and then you're taking your distribution out then? There are advantages to taking it out monthly, perhaps even a couple times a year or once per year. If you can kind of ride out some of that, maybe some of the ups and downs of the market throughout the year, you're expecting maybe a low volatility environment throughout the year, then a lump sum could be best. Again, if you need that cash flow, taking RMDs out monthly could be better for you. And then, of course, if you don't need the money at all and you're charitably inclined, there are options there for you as well. QCDs, qualified charitable distributions, are a great way and one of the best ways for retirees to continue to just, to give back in retirement.
Sure.
Really a tax advantaged way versus just, donating cash that's already been taxed. We just helped a couple that out of Fairfax, Virginia. They have a little over $6 million. There are typical 6 risk, 60-40 kind of portfolio mix. First year of RMDs for the husband. He's 73 and the wife is 70. And so this is one of the big reasons why they came to meet with us. There's no distribution strategy. So there's no income plan, no roadmap. Here they have a big bucket of money, big pile at over $6 million, not including their real estate. So just all in the IRAs, brokerage accounts, Roths, and things like that. But no income plan and no roadmap, no distribution strategy, no plan to tackle these RMDs, which are substantial for someone who has several million or more dollars put away in IRAs. Those are substantial RMDs. You're talking hundreds of thousands of dollars a year.
Yeah.
I mean, if you had a $4 million IRA or just $4 million in retirement assets, right? Let's just say they're all in IRAs or 401ks. Your first RMD at 73 is close to 4%. It's like around 3.7 or 3.8, but that's over $150,000 a year, right there on a $4 million, pile of money that you'd have to pull out whether you want to or not. Imagine what that's going to do to taxes and just kind of the headaches and stress that causes when, for people at 73, they haven't taken any money out of their accounts yet. And now the government's like, Heather, Uncle Sam here, you got to take your money out. You've deferred money in this 401k and IRA for maybe 50 years. And now you got to pay us and you got to pull it out. And so a lot of people need help and guidance with distributions, withdrawals, all of these things in what we call phase 2 that they really don't have education on. So we helped them put together an income plan and roadmap. We consolidated all their accounts, consolidated the plan. Now we're going to continue focusing on growing their big pile of money, right? They've just worked for 50 years to get here, but they also, just as importantly, needed help with protecting, preserving, distributing the plan for everything that they were missing, other than that accumulation amount of money. That was done through an income plan and roadmap. If you're listening right now, you're 55 years old and older, perhaps you're getting really close to RMDs. You're 70, 72, you're 75. You don't have a plan. You don't have anybody that's helping you kind of process all this for you, calculate it for you. Give us a call. If you're 55 and older, you've saved $500,000 or more for your retirement. We want to give you the same plan, the same strategies that we offer to this couple in Fairfax, Virginia. That was done through a retirement income plan and roadmap. Get clear on your distribution strategy. You already have the growth in the assets. Put the distribution strategy in place, complementary.
All right, something else a lot of us are talking about right now is because of the conversation we've been hearing continue to go on about the Fed and the moves that it may or may not make. We did just see another quarter-point interest rate cut. The big reason why is to address higher unemployment rates. However, strategist Evan Brown is saying that history shows us that this strategy can, in fact, also pay off for investors. This is Evan Brown.
First of all, it's a strange economy right now. We're talking about that GDP is quite strong, but the labor market is soft, and we're waiting to see how that will evolve. But the soft labor market is what's getting the Fed to cut. And just history shows when the Fed is easing and the economy is holding up and earnings are strong, that's some of the best returns that you get in equities. And so I think it's kind of keep it simple. This is a good environment for stocks.
All right. If rate cuts are good for stocks, as somebody that you work with, somebody who's close to retirement age, should they continue to lean into equities or do we need to stay cautious? What are you recommending to folks?
Yeah, that's a great question. Well, if you are just about to retire or already have retired and you already have the amount of money you need to retire successfully with dignity and confidence, you probably don't want to continue to take on more risk, right? If anything, if you have your number, if you have the amount you need to get this money to last you the next 20, 30, 40 years, then we want to do everything we can to protect it, preserve it, and make sure it lasts. Now, that doesn't mean going more heavily into stocks, probably not. It also doesn't mean going to the sidelines, right? You want to have a good mix. So I would say most of the time here at Abich, we're always cautiously optimistic. We are positive about the future. We are definitely more bullish than bearish. However, with that said, markets are also at all-time highs. I just saw a stat the other day that said about 45% of the S&P 500's growth this year has come from 10 companies.
Yeah.
Now, there are 500 companies in the index.
Right.
45% of this index's growth has come from the top 10 companies in this index. A lot of them being the Mag 7. You've heard the names over the last few years: Microsoft, Apple, Amazon, Netflix, and a handful of others. Well, what about the other 55% of that index, the S&P 500? Oh, they're responsible for the other 50%. So are we sitting at maybe the top or close to a bubble here like we did, back in the dot-com era in the early 2000s? I don't know, but it's something that we want to talk to our clients about. It's something you need to be aware of, that markets are at all-time highs and that valuations are really high and all these things. You really want to be aware and just not be blind to the fact that although these tech companies and artificial intelligence is leading the way, man, we really want to be aware of what's going on.
Right.
We just helped a couple in Herndon, Virginia. They have about $3.5 to $4 million, also a 6 risk on our scale of 1 to 10, that classic 60-40, or they desired to be, should I say, a 60-40.
Okay.
I've been working with a phase 1 firm, really well-known firm here in the area that is not only local, but national as well. But they really didn't have a relationship with the advisor at this firm, maybe 1 to 2 phone calls a year, and there's no proactive quarterly meetings like we offer here at Abich. They've been in the same portfolio for the most part, a lot of mutual funds, some ETFs for like the last 10 to 15 years without a lot of change, wanting to make sure that they're fully set up for retirement because they're getting no retirement help.
Yeah.
They got the accumulation help. They got the investment advice that got them to the 3.5 or 4 million. And here they are sitting, asking their current advisor when they do speak to them, well, what about when should I take Social Security? What about RMDs? What about taxes? What about healthcare? What about distributions? Which account should I take out? If you're getting generic rules of thumb when it comes to the answers to all those questions, you probably need to seek out a second opinion, right? Or if the advisor is just saying, take 4% out of your assets the rest of your life, just wait till 70 to take Social Security. Don't worry about taxes. They're not going to be higher and things like that.
Yeah.
You probably need to seek out a second opinion. Well, they did with us. And what we found out is when we did a portfolio x-ray for them, went under the hood, put all their investments into our software, we found out that they're actually currently a 90-10. That means 90% of their $3.5 to $4 million is currently or was currently in stocks when they want to be a 60-40. Big disconnect there. Oftentimes people think that they're invested way more conservatively than they are. They want to be a 60-40 or maybe a 50-50 or somewhere in that range. And they've got 70, 80, 90% of their money in stocks, which was a big reason why this couple got to $3.5 to $4 million bucks. However, they've won the game, right? They have enough money to retire successfully. And they knew as soon as they saw that they needed to de-risk. They needed to reduce risk, pull in the reins, and get to a portfolio allocation that would be smart and cautiously optimistic for the rest of their lives. We reduced them down to a 60-40, and that was all discovered for them through a portfolio x-ray. So if you're 55 years old and older, you've saved $500,000 or more for your retirement. We want to offer you the same portfolio x-ray that we offer to this couple in Herndon, Virginia, complimentary, that portfolio x-ray.
So when people hit those early 60s, a lot of us ready to just call it quits. They're looking forward to setting off into the sunset in their retirement years. However, there are still plenty of people in this phase of their life. What if things are going great at work? They have hit a stride. They are feeling like they're contributing. Everything is going really, really well. They're not ready to retire. They got another 5, 6, 7 years in them, Abe.
Sure.
For somebody who is in that circumstance, what do they need to be considering and planning for?
And that's a great position to be in.
Sure.
And that's the case for a lot of people. Obviously, there's a lot of people that have had a successful career and they just know when they're ready and they want to check out and they know. But there's a lot of other people who maybe are in their early 60s who could go another 3, 5, maybe 7 years and they love what they do. It's not stressful.
Right.
Maybe they can create their own schedule. Maybe they've fully retired, but they're working like a part-time consultant. And they can dictate their schedule and work as little or as many hours as they want and still make $100,000, $200,000 in part-time income. We see it all the time, which is amazing, right? Because now you have that income coming in. You don't have to touch your portfolio. Well, if you're in that position and you've got a few years ahead of you, you don't need to retire, you want to continue working another handful of years perhaps, then we really encourage you to start drafting a plan because you'll be well ahead of the game if you start drafting your retirement strategy while you're still employed. We've got time to work on this, right? Versus telling me that you're going to retire in 6 months or want to retire in 6 months. There's a lot less we can do. And way more planning we can do the more time we have, obviously. Far too many people wait until after they've stopped working when it's often too late to make meaningful adjustments to ensure a fulfilling retirement. You also want to look into health insurance. While you're still working and covered, take time to see what insurance may remain in effect after you retire or where your coverage may come up short or vanish completely. It's a huge expense for people that retire early that aren't covered, that need to pay for their own health insurance before Medicare. Create a flexible retirement plan. If you're working for a company, especially a larger one, you probably have access to a 401k type of plan, a TSP. It's also worth looking into accounts held outside of your employer where you can consolidate. Obviously, those would be IRAs, Roth IRAs. These types of plans have usually less restrictive rules and may offer more flexibility in terms of investment options. So I would highly encourage setting up a plan. If you're basically 5 years or less away from full retirement, it's the retirement red zone, football season right now. You're at the goal line of retirement. It's not too early to do so. And we just helped a couple just like this in Haymarket, Virginia. They are 65 and 68, $3 million saved. They're going to retire in 2 to 3 years, right? So we're talking months. No retirement plan, just the $3 million. Yeah. They love to work. It's not stressful. They golf all the time. Yeah. They travel all the time. Really good income coming in, and they love their lives. And they want the income to continue to come in for a few more years until they're fully satisfied. We put together a retirement roadmap, a proactive plan in place in advance before retirement, gave them all the confidence they needed to retire on their terms. If you're 55 and older, you've saved $500,000 or more for your retirement, we want to help you retire on your terms as well. That can be discovered through our retirement roadmap, complimentary.
Let's start that conversation. You can find us anytime. Visit us at theretirementkey.com.
Thanks for listening to the Retirement Key Podcast with Abe Abich. To learn more about Abich Financial Services, visit theretirementkey.com. And join Abe for his radio show, The Retirement Key, Saturdays at 8 a.m. and 2 p.m. and Sundays at 8 a.m., 2 p.m., and 5 p.m. Abish Financial Wealth Management is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. The information contained in this material is intended to provide general information about Abish Financial Wealth Management and its services. It is not intended to offer investment advice. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Information regarding investment products and services are provided solely to read about our investment philosophy and our strategies.